Welcome to Season 3, Episode 2 of Retire Eyes Wide Open. I'm Scot Landborg. Today we're talking perspective and gratitude and about AI. What a mishmash. We'll cover the top news in our money rundown. We'll take listener questions, money with Murph. We'll cover the rage of artificial intelligence. And we'll try to bring some perspective on how you can be more present in the now. This is Retire Eyes Wide Open.
The strategies and concepts discussed are for educational purposes only and do not represent specific investment, tax, or estate planning advice. Investing carries an inherent element of risk, and it is in everyone's best interest to consult a tax, legal, or investment professional. Scot Landborg and Stephen Murphy are investment advisor representatives of, and securities and advisory services are offered through USA Financial Securities Corp., member FINRA and SIPC, a registered investment advisor. Sterling Wealth Partners is not affiliated with USA Financial Securities Corp.
Hi, I'm Scot Landborg. I'm going to show you how to retire with your eyes wide open.
Welcome to Retire Eyes Wide Open.
Don't go into retirement with your eyes closed. Go into it with your eyes wide open.
If your financial advisor and tax advisor aren't talking, someone isn't doing their job.
There are two systems in this country, one for the informed and one for the uninformed.
You can't turn back the clock. It'll only get better for the future. You're going to look back at this moment 20 years from now, and you want to know you did everything you could to position your financial life. The world is changing, and so is retirement.
Don't go into retirement with your eyes closed. Go into it with your eyes wide open. I'm going to show you how to retire with your eyes wide open.
Now for the best thing I saw this week. Alex Hormozi, founder of acquisition.com, YouTube star, business guru, posted a piece on gratitude that really hit me. He talks about one of the tools he uses to be grateful. He imagines that he's 85 years old. He's only 32, by the way. Imagines himself at 85. And if he had a time machine at 85, it could travel back in time to right now, to this moment. How would that change his perspective? Maybe you're 55. Maybe you're 65. Imagine for a minute you're 85 and you travel back to view yourself right now. View yourself. What would you think? Wow, 60 is great. My body is great. Not a medical concern in the world. Body feels good. That moment with my wife, the walks, happy hour, time with my granddaughter, dinner with family. If you looked back at this moment 20 years from now, what would you think? What would you feel? What would you be grateful for? What would you tell yourself to do differently? I was at home with my boys, one's 7, one's 4. It was dusk, sun just about to go down. And we were wrestling on the couch. We do a lot of that with 2 active boys. They love it, so do I. And as we were playing, I thought I saw something out of the corner of my eye, something outside the window. Do you ever get that feeling ever once in a while that somebody's watching? Probably was just a reflection from a car passing by. But for a moment, I thought, what if it was me? From the future, sneaking a peek on a special moment as my 85-year-old self. As weird as that sounds, for a moment, that's where my mind was. At 85, wanting to go back to that moment with 2 boys, roughhousing, playing, wrestling. Be present in now. Be mindful of small beauty. If you're in retirement or approaching retirement, know that this next phase, it's not all about the fireworks. It's not all about that big epic vacation. It's about doing more of what you want, doing less of what you don't. It's about making the most of those moments, even the small ones. And gratefulness, mindfulness can make that journey so much more enjoyable. How can the perspective of an 85-year-old change your mindset and your view of where you are right now? Of the challenges that you face, of the beauty of day to day? What would you tell yourself if 20 years from now you could go back in time? What would you tell yourself to cherish, to value, to soak in? What would you tell yourself to change, to move on from, to not care about? Gratitude is a powerful force. And that's the best thing I saw this week. And now for the Money Rundown. Our Money Rundown segment is where we cover the recent news. There's a lot of media sources out there that are going to help give you updated information about the economy and the markets. Our job is to help you summarize, synthesize, and help pick out a few stories that are most important for you as a retiree or an investor. Joining us today is financial advisor Stephen Murphy. Welcome, Stephen.
Thanks, Scott. Story number 1, debt ceiling resolution. Earlier this month, the president and the Republicans reached a deal to avoid a U.S. default and resolved the debt ceiling risk. What are the biggest takeaways for investors, and are there still lingering risks?
Oh, man, thanks, Stephen. I mean, this is a huge story for a month or two going up to the resolution of the debt ceiling, and really thankful that it got resolved. It was scary at the time, but like every time before, they fixed it and they've resolved it. The biggest takeaways are a few things. Number one, there isn't going to be any more debt ceiling debate until 2025. That's been deferred, the can's been kicked down the road. There were some small spending caps. There was a clawback of COVID funds, some work requirements for government benefits, some IRS cuts, and student loans are going to have to be repaid. Those are the biggest takeaways from the bill. But the biggest takeaway today from investors now is when we look at the past debt ceiling issues, there was a lot of volatility around the stock market around that, and the volatility continued after there was resolution. And the biggest reason was the downgrade of U.S. debt. So the thing we're keeping our eye on is there was a story recently in Reuters about there being potential risk of U.S. downgrade still even after they kind of reached a resolution. So it's something to keep an eye on. Is there a potential downgrade in U.S. debt and how that could impact the market, how it could impact the economy, and how it could impact you as an investor?
Story number 2, Treasury Secretary Janet Yellen testified before Congress this week and said that the odds of recession have gone down, and the Fed is no longer expecting a recession in 2023.
I thought this was an interesting story because the odds of recession have been pretty significant for quite a while. But our technical models are showing that the technical indicators in this market, they've been improving. One of our longer term indicators went positive a couple months ago. One of our more intermediate indicators went positive a couple weeks ago. So the technical indicators have been consistently improving. I know, Stephen, you run a number of technical models as well, and things have been improving. So to hear from Treasury Secretary Yellen that they don't think a recession is going to happen this year, I think it's kind of aligned with what we're seeing from the technical side. But I think what's important to remember as an investor is often the stock market can rally in advance of the fundamentals improving. So the economy can get worse, and yet the market can improve. And sometimes it's hard for investors to remember.
Story number 3, Morgan Stanley's Mike Wilson warns about a renewed bear market. Mike Wilson stated earlier this month that economic pressures are still mounting and are likely to bust corporate earnings. He added that a Fed pause can reawaken the bear market. Wilson has maintained his bearish position despite the market having a strong start to the year and entering into a new bull market, which many define as 20% rally off of the lows. This commentary from Wilson came before the last FOMC meeting, where they did in fact pause rates as he did predict. The market did not react well, but a light pullback is very different than a whole new bear market.
Yeah, Mike Wilson, he was right all of last year. He was probably the most bearish of analysts on Wall Street at calling the decline of 2022. But this year, he hasn't been right. And he's acknowledged that, and he thinks he's been a little late to the game. And the market's had a good, strong rally. S&P up double digits, NASDAQ up big. Bonds have been pretty flat. So he's been pretty wrong this year, and yet he's stuck to the bullish thesis. I mean, he thinks that earnings are going to come in worse than expected, that the public's going to be surprised by it, and that the market's going to see a decline. So Mike Wilson maintains his bearish stance on the market, and he is one of the more bearish analysts on Wall Street.
Story number 4, earnings breadth improving. Jury and Timmer of Fidelity put out a chart showing improving earnings breadth of the S&P 500. So what does that mean? It's a measure of percentage of companies that are revising their earnings estimates positively. So 3 months ago, Only 27% of S&P 500 companies had rising earnings estimates for the following quarter. Now it's up to 47%. So it's not perfect, but it is a growing improvement, especially as inflation continues to decrease.
Thanks for that info, Stephen. Yeah, I mean, I think it is more fundamental reasons why this market is moving higher. Naysayers like Mike Wilson have been talking about earnings coming in, about earnings misses, and we just haven't seen that. We haven't seen that. I mean, we're not seeing the same level of growth in earnings that we've seen in prior years, but we're not seeing the level of fall off that you might expect with rates where they are now. So it makes you more bullish on the resilience of the market and the resilience of the economy, increases that likelihood of a potential soft landing despite the Fed raising rates. We just have seen more companies beating earnings expectations and more than we'd normally expect. And that view is in contrast to what Mike Wilson has been saying and gives some ammunition to the bulls in this market.
And story number 5, more bullish historical data. So Ryan Dietrich tweeted out on June 12th a statistic showing the previous 15 times that the S&P 500 reaches a new 52-week high after going 1 year or more without one. 15 of the 15 times, a year later, the market was up and up more than 17% on average. So quite a good 12-month run after that. And we just hit that new 52-week high on June 12th after going more than a year without one.
I saw that tweet from Ryan and I thought it was compelling. I mean, the market's had a great start to the year. And historically, there's more and more data that's lining up that makes you more optimistic about the market moving forward from here. The market could continue to add to gains. Doesn't mean there can't be some volatility in the short term. And it definitely doesn't mean it all clear. When we look at the beginning of this year, analysts were pretty divided on if this market was going to go higher or lower, but really thought the market would be range bound. And the market has pushed to the top of that range, and people have had to revise their estimates on where the market is going from here. Why could it go higher? It could go higher because there's still a lot of cash on the sidelines, a lot of liquidity. It could go lower if the Fed has to keep raising interest rates to slow inflation. We saw that here this last week in the UK. They raised interest rates as inflation. They haven't been able to get a handle on it. So that's something that we could continue to see volatility on. But there's no question there's more and more technical data backing up the fact that we likely are not retesting the lows of last year. And we could potentially see new highs. And for us, it's one of the reasons why we've been pivoting more and more to make sure we're getting exposure to that upside if the market does recover. And for people that are still cautious about the market, there may be some strategies that you can employ to get some upside potential while still mitigating risk. And for us, buffered ETF strategies have been effective for people that are cautiously wanting to get back in the market, get some exposure, but still have some volatility risk and some risk management. And that's our money rundown for the week. Now it's time for Money with Murph.
So this Money with Murph is titled, Is AI a Bubble? So artificial intelligence is all the rage. With the hype initially created with the viral explosion of ChatGPT, it's all we hear about now, and how it will change everyone's lives in the coming years. If you follow earnings reports from various companies, seemingly every management team's golden ticket to receiving an increase in their stock price is simply to talk about how they are utilizing AI, regardless of how good or bad the company's actual quarter was. It's led many people to think, are we in a bubble? Is there a mania regarding AI stocks? But does anyone ever truly know when we are within a bubble, regardless of what the topic is? Well, like many aspects of investing, history tends to be our best guide. We've seen plenty of bubbles and manias in the past decades, some larger than others. For example, the dot-com bubble, the housing bubble, 3D printing stocks, cannabis companies, SPACs, and the metaverse, just to name a few. So let's take a look at some of the common characteristics that these past bubbles have had, and if we share any of those same common characteristics now with artificial intelligence. So number 1, rapid stock price increases. Looking at some various companies that are considered leaders in the artificial intelligence movement, this definitely would seem to be the case. Many have had extraordinary gains in very limited time.
We've seen huge gains in a number of companies tied to AI. And you hit it right on the head, Murph. I mean, it is the rage. People are talking about it. Companies are talking about it. I think there's just no question. It's on everybody's mind, and CEOs have been using it to boost stock prices by talking about it. So, the question is, are we in an AI bubble? Has the run up we've seen in some of these companies been too much? And when you're talking about common traits that you see, there's been a rapid stock rise in a number of these companies, a number of these businesses. So I think you got to be a little bit careful. The thing to remember is sometimes that bubble, that mania, it can last a while, right? It can go on for quite a while. So you may be able to profit by some of that upside in some of these companies. And I think what could make sense is partnering solid fundamental investment analysis with companies that have exposure to AI. I mean, if you can find both of those, I think you're in a good place. I think it's dangerous to be buying just companies just focused on AI that don't have any other fundamentals behind that.
Totally agree, Scott. Number 2 common trait of bubbles: speculation rather than actual methodology. Many times manias are created by what investors think may happen rather than what the actual presentation of steps that companies will take and the value that will be created from those steps.
It's a great point. I mean, I think you got to be careful about companies with AI in the name that are rallying, but there's no real fundamentals behind why that's the case. I think if they're, some of the biggest companies on Wall Street that have rallied, some of the big FANG names have rallied for good reason, because they have legit earnings, they have legit growth capabilities, and their price to earnings ratios may still seem reasonable. I think one of the things to remember about PE ratios is sometimes they can get really stretched with companies that have potential for growth. So what you're looking for in companies like that are not the same PE ratios you're going to see in an energy stock or a dividend stock. That's not necessarily the metric that you're looking for. But I think what's different today than what has been different in past bubbles is you can find companies that have AI exposure and have good fundamentals and good prospects to grow legit existing businesses.
Number 3, Scott, media attention. Bubbles and manias need fuel for their fires, and one of the main sources of that fuel comes in the form of media. They know that the next hot topic will draw viewer attention, and in turn, it begins to create a self-fulfilling prophecy. More investors are drawn to the topic, and because of the influx of attention, it incentivizes the media companies to continue to promote it.
I think one of the craziest things we see in media is the companies that CNBC and Fox Business choose to cover. They cover the ones that are sexy, that are going to get eyeballs, and not always the ones that are necessarily the best investment companies. If you look at some of the best companies over the past couple decades as far as growth, a well-known little pizza shop has way outperformed Amazon over the past 15 years. There's an energy drink company that's been the best performer over the past 2 decades relative to some of these tech firms. So definitely you have to be careful. I'm usually really cautious and pessimistic. Whenever the media gets a hold of something, usually it's too late. I do think the AI thing could have some further legs, though, but you have to be careful with how much the NASDAQ has run up. I mean, the NASDAQ's had a big year so far. We're still off of all-time highs for the NASDAQ, for the S&P, so there's still room for potential growth. But I think if you can mirror great companies that have exposure to AI growth potential, that might be your best opportunity.
And our 4th and final common trait of bubbles is herd mentality. This is, in my opinion, the biggest one. This is the overarching 1,000-foot view of mania and bubbles. This is where FOMO comes in, a fear of missing out. Investors do not want to be the one that missed out on the next big thing. There's a lot of psychology when it comes to investing, and many people would experience more pain by being left behind than from the loss that the entire herd itself suffers.
Yeah, I think definitely FOMO is a real thing. We see it with people that bring us ideas all the time. Anytime there's been an investing mania, you've got people that are knocking on our door talking about how they want to get into it. And a lot of times you're too late to the party. What I would encourage you to think about is, what are those best companies that are part of this mania? And if you see ups and downs in the market, is there a better entry point to get into some of those businesses? If they're great companies and great businesses with like some of those FANG stocks, you might not have an opportunity for a pullback. You might need to have a longer term view, but just know that what goes up quick can come down quick. And almost any one of these mania companies that I've seen over 20 years in this business and in this industry, you often have a better entry point. You think about the shift to non-meat products. You think about pot stocks. You think about crypto. A lot of times you get this mania, and then there's been a much better buying opportunity down the road. And so that may be the case here, and keep your eyes open for opportunities. Those great companies that you like, there may be other better entry points along the way.
Perfectly said. Yep. So only time will tell if we're in a bubble regarding artificial intelligence. If you're considering investing in companies that you believe will benefit from artificial intelligence, just do so with caution and understand that there is a huge amount of risk and likely a significant amount of volatility down the road.
Great. And that's our Money with Murph segment. Stephen, thank you so much. Great job. Now we're going to move on to listener questions. If you want your questions answered during the show, go to our website, retireewo.com, and click on Ask a Question. Stephen, you got our first question?
I do. Charlie in Huntington Beach asks, is international investing more appealing now? I've been mostly a U.S. market kind of guy, but wondering if I should have some international exposure.
We've been getting this question a lot lately. Thanks, Charlie, for the question. Yeah, I think international investing for us is more appealing than it's been in a decade. If you look historically, U.S. investing versus international developed economy investing, U.S. has outperformed for the past 14 years. The last time international outperformed was 2001 to 2008. International did significantly better. So I think now may be a time again for international. International has been lagging significantly, and there may be a period of outperformance. So I think it does make sense to consider some of those developed international markets again. Another driving force is the value of the dollar, which has fluctuated, but it's about as high as it's been over the past 15 plus years. So that can be a driving force helping international investing as well. So I think you want to reevaluate in your overall portfolio. Over the past decade, it's made sense to really underweight your international segment, but now it may make sense to have a more typical weight to international investing, and maybe even overweight to get some more upside potential if markets continue to improve. All right, next question comes from Brian from Anaheim. Brian writes, I'm a teacher in Powder CalSTRS. I've heard of windfall elimination provision. What does it mean, and will it affect me?
Great question, Brian. Yep. So windfall elimination provision, commonly referred to as WEP, that's what you'll hear it as. It is a reduction in your own Social Security benefit due to non-covered pension work. So what does that mean in plain English? So being a part of CalSTRS, you will receive a pension. During your time as a teacher paying into CalSTRS, you did not pay into Social Security. So windfall elimination will affect your own benefit if you have at least 10 years of covered work. So covered work meaning you worked in the private sector, you paid into Social Security. Any employment that you've accumulated throughout your life that adds up to 10 years worth will give you a benefit at retirement. Windfall elimination will reduce that amount. So keep in mind, when you get your Social Security statements in the mail, when you start hitting age 60, they will say an amount. Hypothetically, let's just say that amount $700. Now, keep in mind that is not reflected of a WEP reduction. So don't necessarily bank on getting that $700. Windfall elimination provision will lower that amount. So make sure if you're doing your financial plan yourself, or if you have a planner that's doing it, make sure they're aware of this provision, and that the amount on your Social Security statement likely is not going to be the amount that actually hits your bank account. Jim in Los Angeles asks, what about regular bonds? Is it time to get out of short-term bonds for a longer term? What happens if rates get cut in the future?
Jim, thanks for the question. Yeah, I think bonds are really interesting. Safe money investing is more appealing today than it's been in 20 years because interest rates are much higher than they were a year ago. If you look at CDs and savings accounts, you're getting 4 to 5% versus a year ago, you're getting paid less than 1%. So there's a lot more opportunities for a safe money investor, and bonds are one of them. A lot of people have piled into short duration bonds, but as the Fed gets closer to saying enough is enough with raising rates, intermediate and longer term could become more appealing. You're not going to get a higher rate, but you could get potentially more appreciation potential. And I think the thing to remember as a short-term safe money investor is, what is your reinvestment risk? If you buy a 1-year CD, if you buy short duration treasuries, and if the Fed cuts rates a year from now or 2 years from now, and now you can only reinvest that at 2% or 1%, how does that change your investment thesis, and how does that play into your long-term picture? So I think you need to start thinking about having a more intermediate to longer term view about your bonds. You're not going to necessarily make more money in yield, but you might get some appreciation potential if the Fed cuts rates in the future. Some appreciation potential, and get some of those higher yielding instruments. All right, our next question comes from Terrence from San Juan Capistrano. Terrence writes, my 401k at work is invested in target date funds for the year I plan to retire, but I keep hearing negative things about them. Are they bad?
Terrence, great question. This target date funds in general are going to be a little bit more applicable no matter what account you have. In Terrence's case, it's a 401k, but that could be a 403b, 457, an IRA, a Roth IRA. It's just an investment selection like any other stock or ETF. But to your question of, are they bad? It's going to be relative to you. What you're probably hearing about a lot of the negativity about target date funds is that they probably are going to be a little bit too conservative as you approach retirement and go into retirement. So when you're 35, 40 years old, a target date fund might have the equity exposure you need to meet your goals for your portfolio. But target date funds are notorious for getting way too conservative, way too quickly. It's a common misconception. I'm approaching retirement. I'm not 25, I'm not 35 anymore. I need to be conservative, which there's an element of truth to that. But you have to keep in mind, hypothetically, let's say you retire at age 65, you still can have, there's a 50% chance you're going to live till 90, 95 years old. You still have 30 more years of investment ahead of you. So you need to make sure that your allocation, even though you're retired, is still going to meet your goals as you live to 90, 95 years old. So that's probably where you're coming and hearing from some negativity about target date funds, is they get way too conservative, way too quickly when you still have a long time ahead of you for your investing journey.
Steven, let me chime in on that. One of the other challenges with target funds is you have this more passive allocation that is not necessarily reflective of what's happening in the market or the economy today. They've been set up with giving you more equity exposure and dialing down as you get older, increasing your bond exposure. But the question is, in an environment where interest rates went up last year, target funds got hit because you didn't pivot to more short-term bond allocation. You had a more passive bond allocation, intermediate and longer term was in there, even though we know the Fed was telling us they were going to raise interest rates and bonds were going to get hit hard. Last year, bonds down 15%, worst year for bonds in 40 years. That wasn't helpful. So, target date funds are really a blunt instrument. And with anyone, there may be a more precise way of investing other than target date. You could put together a list of those available strategies. Maybe you want to have more exposure to US, more exposure to NASDAQ, more exposure to international. Maybe the type of bonds you have could be more laser focused to help optimize long-term performance. So I think the challenge with target date funds, if you've got a little bit of money and you don't want to take the time to look at it, they can be an interesting instrument, but they're really a blunt instrument. And there can be some ways to optimize inside of those asset classes if you're willing to take the time.
Yep, great point, Scott. And our final question is Angela from Minneapolis. Do you have any investing tips for this market? It's been a nice run up this year, but will it last?
That's a good question. I think this market is interesting. We have had a really good run up already, and how much further can we go? We'll see. We're still off the highs for all the major indices, S&P, NASDAQ. We've seen the lion's share of the move in this market has been the top 10 stocks in the S&P. The bottom 490 have been kind of flat. Now, we've seen some movement in those bottom 490 stocks that makes us a little bit more optimistic. But strategies for investing, I think number one, you want to look at buffered ETF strategies that could give you upside potential with mitigating risk. You want to look at barrier ETF strategies that might be able to give you a higher yield if you're willing to take on a little bit of risk. I think you want to look at some of your individual stocks and individual sector selection to see where there might be some opportunities to grow and some opportunities to catch up with the market as it's gone higher. And then finally, you want to think about, how does your investment philosophy fit in the longer term and fit into your overall plan? If you're a younger investor with a lot of time ahead of you, it might make sense to pile on some more risk and think for the long term. But if you're a retiree or close to retirement, it might make sense to evaluate some of those more conservative strategies, considering that they're paying a much higher yield than they were likely paying a year ago. And there's more opportunities in that space for a conservative investor. So those are some of my top tips for this environment. That's our show for this week. If you want some of your questions answered, I encourage you to go to our website, retireewo.com, and click on Ask a Question. If you want to sit down and talk more about your situation one-on-one, go to our website and click on Schedule a Consult. We're happy to help. Go like us on Facebook to get our most up-to-date content. Subscribe to our podcast. We'll see you next time, where we'll show you more how to retire with your eyes wide open. Don't go to retirement with your eyes closed. Go into it with your eyes wide open. I'm Scot Landborg, here with Stephen Murphy. We'll see you soon.